Welcome to Cryptocurrency Compliance, where we go beyond the basics and delve into the technical aspects of staying compliant in the crypto world. Each week, we'll bring you expert insights and practical advice on the latest developments in blockchain, cryptocurrency regulations, and more. In this episode, we'll take a closer look at some key jurisdictional differences and the benefits and risks of doing a security token offering or STO. But first, let's define what security tokens are. Security tokens are a type of cryptocurrency that represent ownership in a company or asset, such as real estate or fine art. They can be traded on digital asset exchanges and are subject to federal and state securities laws in many countries. According to a report by PwC, the global market for security tokens is expected to reach $40 billion by 2025. Now let's look at some specific countries and regions to see how they approach security tokens. The United States has taken a measured approach to security tokens, treating them as traditional securities and requiring companies to register their offerings with the Securities and Exchange Commission (SEC). However, there are certain exemptions from registration that may be available to some companies. For example, the Reg D exemption allows companies to sell securities to accredited investors without registering the offering with the SEC. The Reg A Plus exemption allows companies to sell securities to the general public, but there are limits on the amount of money that can be raised and the type of securities that can be sold. Switzerland has taken a more liberal approach to security tokens, with the Swiss Financial Market Supervisory Authority, FINMA, issuing guidelines for the issuance and trading of digital assets. This has made Switzerland a popular destination for STOs, as it offers a more clear-cut regulatory environment for companies. However, some critics have argued that Switzerland's approach is too lenient and that it could be attractive to companies looking to avoid stricter regulation in other jurisdictions. Singapore is another jurisdiction that has taken a proactive approach to security tokens. The Monetary Authority of Singapore, MAS, has issued guidelines for the issuance and trading of digital tokens, including security tokens. Singapore has also established a regulatory sandbox for fintech companies, which allows them to test their products and services in a controlled environment. Now let's turn to Europe. The European Union (EU) has taken a more fragmented approach to security tokens, with each member state taking its own approach to regulation. The EU has issued some guidance on digital assets, including the EU Digital Finance Package, which aims to provide a framework for the regulation of digital assets, including security tokens. However, the EU has not yet adopted specific regulations for security tokens, and it is up to each member state to determine its own approach. There are several key regulatory entities in Europe that are relevant to security tokens. The European Securities and Markets Authority (ESMA) is an EU regulatory agency that is responsible for regulating the securities and financial markets in the EU. The ESMA has issued guidelines on the application of EU financial regulations to digital assets, including security tokens. The European Central Bank (ECB) is another key regulatory entity in Europe. The ECB is responsible for the monetary policy of the euro area, which includes the 19 EU countries that have adopted the euro as their currency. The ECB has not yet taken a formal position on security tokens, but it has expressed some concerns about their potential risks, such as liquidity risk and market manipulation. In terms of exemptions, the EU has a few options available. The Prospectus Directive allows companies to sell securities to the general public without registering the offering with national regulatory authorities, as long as the offering meets certain conditions, such as the size of the offering and the type of securities being sold. There is also the Private Placement Exemption, which allows companies to sell securities to a limited number of investors without registering the offering with national regulatory authorities. Now let's consider the benefits and risks of doing an STO. One of the major benefits of doing an STO is access to a wider pool of investors. Because security tokens can be traded on digital asset exchanges, companies can potentially reach a global audience of investors who may not have been able to participate in a traditional securities offering. This can be especially useful for companies in emerging markets or those with a unique business model that may not be well understood by traditional investors. In fact, a recent survey by Deloitte found that STOs have the potential to democratize access to capital, with 63% of respondents saying that STOs make it easier for smaller investors to participate in fundraising rounds. Increased liquidity is another benefit of security tokens. Because they can be easily bought and sold on digital asset exchanges, investors can more easily exit their positions if they need to. This can be especially appealing for investors who may be looking for a quicker exit than is typically possible with traditional securities. Improved investor protection is another potential benefit of security tokens. Because they are subject to federal and state securities laws, investors are entitled to certain protections, such as the right to receive financial statements and other information about the company. This can help investors make more informed decisions and reduce their risk of fraud or other abuses. Of course, there are also risks associated with doing an STO. One of the biggest risks is regulatory uncertainty. Because the regulatory landscape for security tokens is still evolving, it can be difficult for companies to know exactly what is required of them. This can create uncertainty and increase the risk of enforcement action by regulatory authorities. Compliance costs are another risk of doing an STO. Because security tokens are subject to federal and state securities laws, companies may incur significant costs in order to comply with these regulations. This can be a burden for companies, especially those with limited resources. Finally, there is the risk of potential enforcement action by regulatory authorities. If a company does not comply with the relevant regulations or engages in fraudulent activity, it could be subject to enforcement action, which could result in fines, legal costs, and reputational damage. Now let's take a look at some examples of successful and failed STOs. One example of a successful STO is tZERO, a blockchain-based platform for trading and issuing security tokens. In 2018, tZERO raised $134 million in an STO, making it one of the largest STOs to date. On the other hand, there have also been several high-profile failed STOs. One example is the Telegram Open Network (TON) STO, which was shut down by the SEC in 2020 after the agency determined that it was an unregistered securities offering. Telegram was forced to return $1.2 billion to investors and pay an additional $18.5 million fine. In conclusion, the regulatory landscape for security tokens is still evolving, with different countries and regions taking different approaches to their definition, taxation, and regulation. Companies and investors considering an STO should carefully consider the benefits and risks of doing so in different jurisdictions and seek professional advice before making a decision. While security tokens offer many benefits, such as access to a wider pool of investors, increased liquidity, and improved investor protection, they also come with risks, such as regulatory uncertainty, compliance costs, and potential enforcement action. There are also potential exemptions from the requirement to register securities in some jurisdictions, such as the Reg D and Reg A+ exemptions in the United States and the Prospectus Directive and private placement exemptions in the EU. However, these exemptions come with their own set of rules and limitations, and it's important for companies to carefully consider whether they are eligible and whether it is the right fit for their needs. Thank you for joining us on Cryptocurrency Compliance for this episode exploring the current state of security token regulation around the world. We hope you found the information and analysis provided to be valuable and insightful. Until next time, thank you for tuning in and supporting our podcast.